and welcome to this session. This is Professor Farhat. In this session, we're going to look at transaction that deals with purchases, specifically under the perpetual inventory system. So when we buy product, we can buy a product using cash, basically pay cash, or we can buy product on account. Now, in the real world, most transactions are on account. Basically, we buy, then we pay for later. Okay? Normally, you would record the accounts payable when goods are received. So when do you record the payable? When does the accounts payable goes on the books? If you buy something, once you receive it, it goes on the books. And purchase invoice should support each credit purchase. So every time you make a purchase, you should have some type of a source document. And for purchases, an invoice, a purchase invoice is a source document, what we call source document for accounting. It means the evidence. What does the purchase invoice include? It includes the name of the seller, obviously, the name of the buyer. So we are buyer. Attention to this individual, the purchasing agent. This is their address. And this is what they purchased. A printed circuit city board prototype and production model circuits, 1 unit and 5 units. Here's the unit price for each. And if there's any taxes, they will have the taxes. They will also have the credit terms, which is 2/10 and 30, which we'll talk about shortly, the date. And if there's any shipping terms, we also will talk about this shortly. So this is what a purchase invoice looks like. So we purchased 3,800 worth of merchandise inventory. Let's go ahead and journalize this purchase. So we made this purchase, let's journalize it. So if we have the source document, what we do is we debit inventory because we have more inventory, which is an asset. And to be more specific, inventory is a current asset. Since we bought it on account, we credit accounts payable. And notice the date is May 4th. We credit accounts payable. Now let's talk about the shipping term. It says here FOB shipping. So we need to know, what does it mean, FOB shipping? When you buy something, you have to know what are the shipping terms. FOB shipping means what? FOB shipping means the ownership passes to the buyer, okay, as soon as it leaves the store. So this is the seller. So the buyer drove their van. Let's assume the buyer drove their van to the seller, and the buyer picked up the product and put it in their van. We're going to assume this is their van. It doesn't have to be their van. They might have hired a van, but it's their responsibility. As soon as the buyer leaves the store, as soon as we leave the store, this inventory becomes the buyer's responsibility. So the ownership of the goods passes to the buyer when the public carrier accepts the goods from the seller. And here, to keep it simple, assuming the buyer went there and picked it up. Now, the buyer doesn't have to be there. All what the buyer has to do is pay for the shipping. Now, if the shipping term is FOB, on the other hand, we could have FOB destination. What is FOB destination? Say, notice here, FOB destination. FOB destination means if you are the buyer, the product is not really yours until they deliver it to your store. So notice the seller now delivering the product to the buyer. And it's not really the buyer until they knock on your door at your place of business and they hand it to you. So ownership of the goods remain with the seller until the goods reach the buyer. Now you might be saying, what's the big deal? The big deal is this. We have the buyer here, and we have the seller, and we have the buyer. Those could be next door to each other, and those could be a continent away from each other, okay? So what happened during transportation? Well, if the buyer said it's FOB shipping, if the buyer said, I'm buying this FOB shipping, it means as soon as it leaves the seller, it's yours. If the buyer says, I'm buying this FOB destination, it means it's the seller's responsibility all the way until it gets to the buyer. And many things could happen along the route. That's why we just say, whose responsibility is it? Is it the responsibility of the buyer or the responsibility of the seller? It all depends on the terms. Now, freight cost, which is transportation cost, incurred by the seller. Be careful here, by the seller. It's important because not by the buyer. It's considered an operating cost. And hopefully, if you think about it for a moment, it makes sense. If you want to incur a cost to sell something, then it's part of your selling expenses, part of your operating expenses, because you need to ship it to the buyer. It's part of your expenses. So by the seller, it's an expense. For the buyer, it's going to be a little bit different. Okay? Assume upon delivery of the goods on May 6, Sock Stereo pays public freight company $150 for freight charges. So now the buyer pays. Now this is FOB shipping. Now remember, this is the buyer. The buyer is paying for shipment. The buyer is paying for the shipment. So the buyer is responsible. Therefore, the buyer will debit $150 of inventory. Okay, and hopefully this makes sense. If you buy something online for $15 and you had to pay $3 shipping, this item costs you $18. Simply put, because you are the buyer, the freight is added to your cost. So whatever you bought, you add the freight, the transportation to your cost. Now let's change the example. Let's assume the freight terms had PW audio supply. So now the seller is paying for the charges. So the seller says, I'm responsible for the charges. How would the seller record this? The seller would record it as a freight out, which is an expense. An expense. This is a freight out. Freight out is an expense, and this is a freight in. Freight in is an asset. So the seller would treat the transportation as an expense. Obviously, they don't both pay for it. One will pay, but just you need to know when someone pays, how does it work? How does the seller treats the payment, and how does the buyer treats the payment? So what happened if you bought something and you are dissatisfied because the goods are damaged or defective or inferior or do not meet specifications? So you bought something and you did not like it, or they send you the wrong color or the wrong size, or the package arrived damaged. Well, you have two options. One, you can do a purchase return. What you do is you return the goods for credit if the sale is made for credit, or you would ask for cash if you paid cash. That's one option. The other option is you call and you complain. You call and you complain, and what they would do, they will grant you a purchase allowance. What is a purchase allowance? It's a reduction in your bill. So you may choose to keep the merchandise if the seller would grant you a reduction from the purchase price. So you bought something for $1,000, and the seller said, keep it, and you're only responsible for $900. What they did is they gave you a purchase allowance. So let's take a look at the illustration. Let's assume we return goods costing $300 to PW Audio. Remember, we bought from PW Audio $3,800 worth of goods. Now we return $300, okay? So now the return, think about the return. The return is the opposite of a purchase. Okay, what did we do when we purchase? When we purchase, we debit inventory, we credit AP. Now to do the return, we're gonna do the opposite. We're gonna reverse it. We're gonna debit AP, reduce accounts payable, and reduce our inventory. So this is how we record a purchase return. So in a perpetual inventory system, a return of defective product, of defective merchandise by a purchaser is recording by a credit to what? So remember, we debit AP, we credit inventory. We credit inventory because we actually return the inventory. We credit inventory. Now, since we're talking about this, I just want to let you know, the entry is the same if this was a purchase allowance. If you called and complained and they said, I'm going to reduce your bill by $300, the entry is the same. For the purchase return and the purchase allowance, the entry is the same. The next thing we're going to look at is the credit terms. So the credit terms, you remember on that purchase invoice, it says something 2/10 and 30. What is the credit term? The credit term may permit the buyer to claim a cash discount for prompt payment. So the seller wants you to pay early. So what they do is they say, if you pay early, I will give you a discount. And how do you read this discount? It means 2% within 10 days, or net, none, you don't get a discount, and you have 30 days to pay. Simply put, here's what we're saying. You have 30 days to pay. This is called the credit period. You have credit period of 30 days. If you pay within 10 days of those 30 days, this is called the discount period. So pay within 10 days and you'll get a discount of how much? 2% of your bill. So the purchaser will save money, and the seller shorten the operating cycle by converting the receivable into cash much earlier. So it's a win-win situation for both. The seller gets their money early and the buyer saves some money. Now, when we show the discount, we could show it in many ways. So here's how it could show: 2/10 and 30. It means 2% if you pay within 10 days. Otherwise, the amount is due in 30 days. Or we can show it 1/10 EOM. It means you'll get 1% if you pay within the first 10 days of the next month, EOM. Or N/10 EOM, okay? Net amount due within the first 10 days of the next month. This is how it works. The net amount is due within the first 10 days of next month. So you have till next month, the first 10 days, pay it. Let's take a look at this example. Assume Soak Stereo pays the balance of 3,500. Remember, we purchased 3,800 initially, then we returned 300. Therefore, we only owe them 3,500 on May 14, the last day of the discount period. Now, remember, they gave us a discount of 2%. So if we owe them 3,500, we're going to get 2% off. Another way to see this, if you take 3,500 times 0.98, 0.98 means you're only paying 98%. It means you are going to pay $3,430, okay? Which is $70 off. So what you do is you debit accounts payable for the full amount. So you debit accounts payable for the full amount. You are only paying $3,430. Why $3,430? You owe them $3,500, but you're going to get a discount of $70. Then the difference is the savings. What you do is you reduce your inventory cost. Notice in a perpetual inventory system, what you do, the system is so smart that you know you need to reduce your inventory cost. Therefore, you credit inventory for $30. So the discount, so I'm going to put this in quote. We don't call it discount in a perpetual inventory system, which is basically, to be more specific, a purchase discount. What do you call a purchase discount in a perpetual inventory system? You don't call it anything. You reduce your inventory directly. Let's assume you did not pay within the discount period. You waited 10 days later, then you have to pay the full amount. Then you owe them $3,500. You have to pay cash and accounts payable because you did not take advantage of your discount period. So should you take the discount when it's offered? So let's compute how a discount is computed. Is it worth it? Well, you're getting 2% of 3,500, you're saving $70. Is it worth it? Well, let's see if you have 3,500 and you can invest this at 10% for 20 days. Well, simply put, if you take 3,500, you multiply it by 10%, multiply it by 20 divided by 360 or 365, usually they use 360 as an interest, you make $20. So notice, if you have 3,500 and you invest it at 10%, you only make $20. But if you pay early, you will save 70. So definitely you should, so your savings are more than 10%. Okay? Your savings are more than 10%. Now to know exactly how much is your saving, how much you are earning, let's think about it. You are earning 2% for 20 days. Why 20 days? Let's show you why 20 days. You have 30 days to pay. 30 days to pay. And you paid within the first 10 days. So by paying early, by paying 20 days earlier, you saved yourself 2%. So you saved 2% within 20 days. If you do this continuously, okay, you have 365 divided by 20, you have approximately 18 cycles. So you are saving 2% approximately 18 times a year, because you have 20 days a year. So you are making 36.5% if you continuously pay your amount within the discount period. So you are saving yourself 36.5%. So that's why 10% is not good enough. Even if you have to borrow the money at 10% to pay within the discount period, you should do it. And to prove it, it's 36%. If you take 3,500 times 36.5% multiplied by 20 divided by 365, you would say you are saving $70. So it's very important that you take advantage of the discount. And the reason is simple, because by taking advantage of the discount, you are saving yourself 36.5%, which is a high rate of return. And this is your inventory account. So inventory, when you make a purchase, you debit inventory, inventory goes up. If you paid for transportation cost, notice here on the 6th, we paid for transportation cost increase inventory. If you make a return, your inventory goes down. If you pay within the discount period, inventory goes down. So there is a formula here, and this is the balance. So what is the formula? What is the formula here? Here's the formula. It's your purchases plus your freight in minus return and allowance. If you have any allowance, we did not have any allowance, minus any discount you get. It's going to give you your net purchases, your net inventory or net inventory cost. Okay, so this is the formula. Your purchases plus your transportation cost minus returns and allowances minus discount gives you how much you actually paid for your inventory. Okay, If you have any questions, any comments, by all means, email me or see me in class. And if you're studying for your CPA exam, make sure to study hard. It is worth it.